Hey everybody, Preston Bryn here with our weekly trader roundup, trader user group weekly roundup for the trading week ending July 8th, 2016. It was a holiday shortened week, but it was a very interesting week as far as price action goes. Um, I've got on the screen here the 2-hour chart. As a lot of you know, I like to use the 2-hour chart. It's a good swing trade time frame. 2-hour bars, there's, a little over 3 of them in any given trading day, at least when the normal markets are open, the equity markets are open. And I know a lot of folks like to divide a day into equal time frames, and you come up with these interesting time frame bars. But over time, statistically, there's no advantage doing it one way or the other. So I usually try and keep things as simple as I can. And in this case, I use a 2-hour bar, and it's worked out very well for us for a long time. If I zoom in here, you can see here just a couple of things. I've got a lot of indicators on my chart, and I'm going to leave it here for now. But you can see I've got, and the way I've guided our members through this really crazy, chaotic time. You can see here leading up to the Brexit, right in this area here of the prior Thursday, going into Thursday close, the markets were forecasting the Brexit vote, the British folks to vote to stay. And of course, the markets were front running it all day long, okay? And they ran it all the way up. And then of course, at night when the polling came in, our group, we were up 1 o'clock, 2 o'clock in the morning, New York City time, trading this thing. And as you can see, no doubt, we had this big pullback right here. We had a little bit of a false rally, which is very common in such a deep pullback. Remember, we hit a limit order stop right here for the E-minis. We fell more than 5% before 8:30 in the morning. So they actually put a trading halt to the product until things calmed down. We had this big run up here, and as I was telling our members, I said, be careful here. It's probably just a false rally. A lot of these false rallies here is because as the markets are going down in overnight hours, people are loading up on shorts. And then any bounce that you get, you've got all these buy stops being triggered for those that are short, mostly weak hands. And then once those buy stops run out, and you never know how high you're going to get, but the odds favor somewhere around 50% level, maybe a little bit less from the highs to the lows down here. And we were right at about that level, and then it rolled back over again. And then on the roll down, we had a projection right here. I had a projection. That's where we would go to. And lo and behold, we almost hit it right to the penny. 1981 is where we kind of came back down to, just using some Fibonacci tools and some Elliott wave count. And then we started this massive rally off the bottom. Now, this massive rally as we were going up, a lot of people didn't believe this. They were, excuse me. They were thinking this massive rally was going to be similar to that one. And then it would just come right up here to around the 2016 open price and roll back over again. But our system, especially in the 2-hour chart, and what I was saying is, plan for the worst, put your risk into the trade for the worst, but let's ride it up as far as the market action would give us. And it gave us nice action all the way up. It gave us this 3-leg all the way up to the top up here, right around 2104. I mean, we broke the 2100 level. It only took less than a week to get to. And then as we got into that level on Monday, we started off the week with a little bit of a pullback. But again, I was telling folks that this looks like and the system was labeling a 3-leg, and I concurred. Then we had a 4-leg down here, and I said the new target is going to be right around 2127. Roughly. And that was as we were coming down like this. So I didn't know where we would go. Now that doesn't mean this is what we were going to hit. It just said the probability favored that kind of move. And sure enough, we came down and we caught support in this natural price level right here. And then we moved right back up, and then we hit it almost within a point or two. So we were able to come very close to that area there and that area there. Now, nothing is guaranteed in the price action in the market, but using a combination of Fibonacci extensions, Gann time sequences, which is what these colored bars use, Fib and Gann, as well as Fib pullbacks and retracements and a couple of other tools that we use, we were able to call pretty much within a couple of points, the bottom here right after the Brexit to near the top. Now the question is where to from here. We can see on this 2-hour chart going out in time, we did make new 2016 highs in the E-mini S&P 500 futures at 2125.50. Okay, we did that, and here's the opening price for the S&P 500 E-mini futures, and now you can see we're up in this level here. So what next? Well, I believe, and let me just clear this up, clear the screen a little bit so it'll be a little bit easier to see for you guys. Up in this level right here, there is a mass amount of resistance. On this 2-hour chart, you can see this volume over price right here. Most of that volume over price is sitting right in that area there. I would not be surprised, typically after a 5-leg that sets up for, now we haven't gotten a trigger yet, but a bearish divergence, what we call beds. A little bit of a pullback to test this range again. Should we pull back and then start to move higher, that would be another jumping in point for potential longs. Of course, we got to clear, there is a another huge resistance point here that we hit a number of times over the past year, going all the way back to about 14 months, May 20, where we hit the all-time highs of 2134. So if we come back down in this area and start another run up higher, we could see that. Now, keep in mind, with Elliott waves, typically, after you get a 3, 4, and then a 5 print, we don't know if the 5 print is still final or we can run up higher. But after 5 print, you typically get an ABC pattern like that, which signifies chop after this final run up. Remember, the 3-leg is the long impulse move up. The 4-leg is profit taking. Then you typically have rat brains and others that are late to the dance, and they come in here pushing it up here where a lot of institutional sellers are getting rid of their stuff and taking profits, and then you've got this ABC leg. And then on the ABC leg, you look at the pivot highs and lows of where these form to help you gauge after that, are we going to go higher or are we going to go lower? So what we don't know right now is this the peak of the 5-leg before we have an ABC pattern or not? You never know until it happens, right? We play the odds, but that is kind of what we're looking at right now in this. So we've had a good week, and we're looking at sitting here right on this peak right here, which, by the way, is slightly under the all-time highs here of 2134. You can see up here, okay? You can see the 2015 high is also the all-time high, okay? So that's what we're looking at. If we come out to the daily chart and look at the same pattern here, you can see right here, and let me just move it out to incorporate a couple of years. But you can see here this massive amount of resistance at this level here. And we've spent a lot of time on it, right up in that area there, okay? It looks like it's a wide range, but it's really not. Maybe on a day-to-day basis it could be, but it is about a 30-point range up here. And leave it to the market makers to take out highs just to prove that they can do it, and then we roll back over again. But there is a massive amount of volume underneath that level here, which has basically been a huge turnover of the buyers versus the sellers at this level here. And so far, the sellers have been able to win out. Buyers have never been able to get it much higher. Now, we've got, what I've been telling our members is in the coming 2 or 3 weeks, we got some key earnings of some large money center banks, from Citi to Bank of America to Wells Fargo, JP Morgan, and major insurance companies, but primarily the financial side. And that's going to be followed very closely. Why? Because we've got a lot of financial institutions in Europe that are having a hell of a time. A lot of financial institutions here in the U.S. too, because of the low interest rates. They're going to be looking very closely, analysts, big money, going to be looking very closely at the forward guidance of earnings. If the forward guidance of earnings, primarily financials, comes in very poor, we're not going to get enough energy to get a lot of escape velocity up here. Could we make new all-time highs? Sure. But I think it's going to kind of die a natural death, and we'll come back down into this range again. If we get some good forward guidance, then I think it'll propel us up to the 2150, 2175 area because the markets want to go higher. Remember, it's like holding a beach ball underwater. Markets are predisposed to run higher unless there is negative news coming out that would prevent it from doing so over a longer period of time. I mean, that's just the way the statistics bear everything out. So markets are predisposed to do that. You can see if I take everything off the screen, and let me again just lighten the load here so you can fix your eyes on it. Right here, we have been in this 340 point range for quite some time. We've just never been able to penetrate it, roughly. We've been up at the top, and we've spent a lot of time up here, and we cannot get through it, right? We can't do it. And you can see the peak right up in this area here. So we're trying to penetrate up here, and I believe for us to gain energy and to maintain these levels up here, we've got to have good corporate earnings. They're already calling these earnings are going to be down over 5% quarter over quarter. So that would be Q2 of last year to Q2 this year. And companies are just not doing as well. We should see a boost from energy stocks because the prices are up. It's still not very good, right? Still holding back the rest of the markets. And we've seen up in this area here, those equities that have been doing great are those equities that basically should not be leading the market higher. All right, and what would that be? That would be an example. That would be like the utilities, XLU. If you look at utilities, look at this. We're at all-time highs for the utility sector. All right, you can see when we went into 2016, right here, 43.03 was the opening bid and the opening price for the utility sector. And so we're now near all-time highs, okay? It's amazing. And if we look at the bond market, right, and we say, well, gee, utilities is at an all-time high, and we look at bonds, because utilities is like an equity that trades like bonds, okay? And we look at the bond market, and the bond market is at, you know, all-time highs here. It's the 2016 high, and it's at all-time highs. You know, I mean, just truly runaway market in the bond market. And then if we look at the 10-year interest rate, we've blown through my initial target of 146, and I've got a longer term target for the interest rates down around 115. That would suggest interest rates can go lower here. So we're getting these anomalies here. Normally interest rates go up, bonds, treasury notes go down when the markets start to get stronger because the fear of an interest rate hike by the Feds to control inflation. There is no inflation right now, none at all. And yet, if we come over and look at another asset that tends to move stronger with inflation, right here with gold, you'll see gold already. We've made new 2016 highs in gold right here, okay? And we hit my target of gold, which was 1370, right here with a 3-4-5 pattern, which does suggest a little bit of chop over the next month or so, or at least the next 2 or 3 weeks in gold. But again, we hit not all-time highs, but we hit highs for 2016. You can see the opening price of gold on your chart was down here for the year, right around 1061. And now we're up here for gold finishing at 1367. So, you know, you get 1367. The gold has moved up so far this year, roughly about 306 points, right? Just truly amazing. Just a huge, huge move up in gold. $306 an ounce is gold, and it's just been a rocket ship ride to the upside. A little bit of pullback is going to be in order, but I do believe gold is going higher. Now, there's clearly, why is gold going higher? It's not because there's a fear of inflation. There's zero inflation. That's why bonds are going up. Interest rates are still going down. The markets are saying they do not believe the Feds are going to raise rates till 2017, possibly 2018, way out in time. Now, I know that could, you know, the way our Fed, or way our central bank is working, They say one thing, and then a couple of job reports or other economic data comes out, and they come around and completely do a 180-degree reversal. That's what's got this market so schizophrenic. And then last week we also heard Mark Carney from the Bank of England say they're probably going to have to cut interest rates. They're going to cut corporate taxes. And then Super Mario Draghi came out from the ECB and said, we're going to do whatever it takes. Couple that with the Feds here standing pat and not raising rates. Well, there's no wonder that it's kind of like a Goldilocks scenario where money is funneled into the equity markets, thus moving equities higher and higher, but not just all equities. Utilities, staples, those risk-off assets are what's moving higher. So it's not what you're used to seeing, or at least for those of you old hats that have been around for a while, it's not what we're used to seeing. So when you get these kind of correlations that are not normal correlations, that's because we're in not normal times with central banks all over the world. I think now the negative yielding corporate debt globally is over 13 million plus, okay, or 13 trillion in corporate debt around the world. That is truly amazing. That is why our bond market looks like our chart in gold. Money, and I've been saying this all year long, is coming from Europe and Japan into here because a lot of those negative interest rates are over there. And it's just amazing how this thing is playing itself out. So where does that leave us for next week? You know, if we look at the if we come back to the S&P 500, and I'm going to step back out for just 1 second here, and we look at the E-minis, and let's put it back on a weekly chart here. I am still sticking to my forecast, and let me just turn off all my indicators here and leave just the Fibonacci retracements from the March 6 lows of 2009 to the May 20 highs of 2015. I do believe, and I said this last Sunday too, even if we make new all-time highs, okay, I just, between now and let's say 16 to 18 months on a go-forward basis, that's about a year and a quarter to 4 quarters to 6 quarters of data, I think we're going to be down, or we're going to work our way down to 26+% to the downside. An official bear market is 20%, but most bear markets don't stop at 20%. As you guys know, the markets always overdo it to the upside and to the downside. In this case, we're not going to fall over 50% like we did in 07 or 8 and in the dot-com bubble. But I do believe we're going to see north of 25%, which, by the way, takes us down to this first natural fib node of 1573. Okay, that is going to be a key number that I'm going to be looking at. And if we zoom out on this weekly chart here, you'll see, as I've said, and I keep showing again and again, and I'll keep doing it, right in this area here. So if you see that, well, why did I erase it? Let's try it again. So if you take this chart right here like that, and then you come in here and you look at that, that is a key fib node, 38%. It also happens to be the high in 07, right? That was the high in 07. It was also the high in the dot-com bubble in 2000. And it's a natural stop-off point. And by the way, from that point to that point there is around 27% from the highs made last May. So that would be, in my mind, a normal pullback. Now, we're not going to get there in one day. We may not even get there in 1 month. But a bear market typically lasts anywhere from 4 months to up to over a year, right? I mean, it can go quite some time. This one started in 07 and didn't finish up till March of 09. Okay, that one started in 2000 and then finished till 03. So it can run for quite some time, and every rally is sold off. And what happens is what we've been into here in this, well, let me just get this off the screen here. What has happened so far right here is because of the central banks. Every sell-off here, central banks start preaching, and then boom, the markets go up higher. And then it gets up to a point where, you know, pick a trigger, it goes back down and the central banks start yakking again. At some point, we're going to come down here and they're just going to believe that the central banks have no control over this, which is what they've never had, right? And then it's going to give a rally like this. People are going to come in expecting it to come back up in this area, and it's not going to do it. It's going to come back down, take that out, and start a run. Then it'll come back up, people will jump in, and then it'll come back down, take that out, and start another run. And that could play out over 6 months to a year, but that's what I think can happen. So, folks, we've got to be extremely careful, okay? Very careful in this market. Right now, I'm going to have our members, and you too should be focusing on the forward guidance of the earnings coming up. That'll be the next, that'll be where the markets can really, you know, take us up to 2150, 2175, possibly even 2200. But without solid earnings or better than expected earnings with good forward guidance, then it's going to be tough. And people are going to be, especially in Europe, they're going to be watching the financial sector when they release their earnings, because the IMF is coming out in about another week or two with their global report, and they're already saying before the report comes out that they're going to downgrade the global GDP numbers and the projected growth prospects, primarily in Europe. And because over 50% of the earnings and the sales in the U.S. companies are to Europe, then you know, and therefore guidance are going to say there's a lot of unknowns, but it could affect us by potentially 5%, 10% in sales, which equals X and Y, which means you're going to see that reflected in the share price if that's what they do. So these earnings are going to be really interesting to play out. You can see on this weekly chart, again, over this weekly time frame where all the right in that area there is where all that volume is, and then it falls off, and then there's a lot of volume down here, and then there's a little bit of volume in this area right here. Okay, so going back, you know, to 2009, there's a big pocket of volume right here, a little bit of volume in here, and a big pocket of volume here. So these would be touch points, you know, depending on how severe it'll get. I don't believe on a pullback we will go much south of the 1573 area, which is what I would expect, or at least to test sometime between, let's say, in the next 16, 18 months, okay? We just got too many assets like gold acting like there's a lot of fear, bonds in the interest rate market acting like there's a lot of fear, a lot of flight to safety, utility sector, stable sector, all of these sectors. Now, I don't want to spend time going over gold and some of the other, or not gold, but oil, and some of the ag products and some of the other things that we're looking at, but we've had a lot of successful trades thus far in the agricultural market, primarily in soybeans, because they've been running around like crazy. But I think there's going to be some good opportunities coming up into this earnings season. The other thing is in the currency market, we've had some good trades in the British pound, primarily to the downside. On this British pound. We'll take it into a daily chart. You can see what it did on the Brexit. It just gave it all up. And now we are humming around the 2016 lows, and this is like a 35-year low, or yeah, down to like 1985. The British pound hadn't seen this like this in a while. I think if they lower the rates, the pound's going to come down below 120, and then right in that area there, I'm going to switch over and I'm going to become a buyer of the pound, because I think longer term, 2 or 3 years from now, the economy in the UK won't even, it'll be like there was never a vote. It'll be a good thing. And folks, we want to be buyers of the pound if this thing gets down in this area down here. Trust me. That'll be a good buy. Right here, right now, no, because any rally is going to be short and fast because of all the shorts in here. It's kind of an overloaded trade, and then boom, it'll roll back over, I suspect, especially if they lower the interest rates, which Carney is on record last week as saying he's looking at that, and I think he may do that. And remember, the lower the pound goes, that's a way for them also to boost their earnings, their exports, because it's like a free discount without doing anything, right? It's just a natural currency reduction. So I think this is going to continue lower. By the same token, if we look at the U.S. dollar, although relatively flat on Friday, is basically making higher lows and higher highs, and it's very, very choppy. But you can see here that we're just moving up in this area here, like this, and now we're up in here. I think it's going to be choppy, If we break this to the downside, then I will short the dollar and go long the euro. But I do believe, and I'm on record as saying this too, that I think long term, 3 to 5 years, the euro is going to be in a lot more trouble than it's in right now. Okay, but right now we're focused on the dollar and the pound and the currency side. The other one that does show a lot of fear is the yen. The yen it's like the U.S. dollar, but more so. The yen is a place or a flight to safety. The yen trades in correlation with the U.S. bond market. When there's a lot of issues, you can see here that the prices just go through the roof in the yen. So, and there's no divergences down here either. So that indicates this is real money coming in here, and it's a lot of buyers of the yen. The Japanese, I suspect, remember, now the Japanese are negative interest rates. The Bank of Japan is trying to reduce the interest rates, and you're seeing the power of the market. They're saying, no, we're not going to buy it. Typically, when a central bank comes out and goes, hey, we're going negative interest rates, the currency goes lower. But look at that. It's got like this rocket ship kind of move because they can't stop. They can't sell as much as the buyers coming in from all over the globe into the yen to seek safety, like it's doing the same thing in the U.S. bond market. Now, on the backside of this big move up, it's always pretty bad. And we could see some huge opportunities setting up in the yen. But can it go higher? Absolutely. If we go back and look at the yen on a longer term basis, look at this. We're not even scratching the surface of where the yen was several years ago. I mean, right up in this area here, for those of you that were members of our group, we made a ton of money in the yen up here. We were shorting the yen like crazy because Shinzo Abe was elected on the premise that he was going to change Japan forever by introducing inflation because they've gone 2 decades without inflation. He was going to change it forever. So he promised to do a lot of stimulus. So once he started winning in the polls, I was telling our members to load up on yen shorts, and it just fell out of bed, right? So it just kept going down and down, and now it's working back up like this. There is a huge resistance area right there, but if it clears this, it can go up higher. And the Bank of Japan is going to do everything they can do to push it down, but if the global markets just continue to buy, they can't stop it. But it's going to be a nice, interesting run, but there's going to be some great trades in the yen as well. And you can see this volume over price, that huge volume right there. So there's a lot of fighting going on right where we are right here. And then you can see this volume just drops off next to nothing. So if it can clear this area and get more buyers, there's not a lot of sellers up in this area. Not until you get back up into this area here. So the only thing that would be a seller right here would be the Bank of Japan. And they wouldn't be able to win out on the markets. Yeah, you'll have those huge days down or a week down, but then the market will win back out and it'll just take it right back up again, like they're doing here right now. So it's going to be a really interesting last 6 months to the year, guys. Be careful. Watch these runs. Everything, I think, near term, because the market is like a petulant child. You saw what it did with the jobs report. Even though if you average out over the past 3 months, the new jobs were horrible, but they were just looking for a reason to go higher. That was the mood of the market on Friday, and it got it. So these earning reports are going to be followed very closely, and the forward guidance to determine the how is the Brexit going to affect these corporations is going to be closely watched. So that's what we're going to do in our membership group. If you're not a member, I highly encourage you to come in and check us out because we're growing very quickly, and I'm glad a lot of our members are on board and you know, now tuned into what we're doing, because you know we one of the nice things that we have is we follow the equities, but we also follow some of the movers in the market that drive equities, from the currencies to some of the commodities, the precious metals, and the energy markets, and natural gas and oils, as well as the ag market. They're right good. They're good trades out there that I think a lot of the market and a lot of traders miss. They just don't actively follow it. But I'm glad to see that, you know, if you come into our group, you'll be introduced to a wider spectrum of asset classes that you can trade, and you don't need to trade commodities to play them either. All right, everybody, have a really great weekend. We got a full week ahead of us, so I will see our members tomorrow night and our up, to review what's coming up for the week. Everybody else, I will talk to you with another weekly roundup the following week. Take care, everybody. Ciao.